Most bull markets have a flavour and a fashion to them, and this bull market up until recently has been very much dominated by growth stocks. And really since the election of President Biden and the sort of successful vaccines that we saw coming through in early November, growth had been dominant. But since then, we've seen bond yields start to back up and value and cyclical stocks outperform. So the banks, for example, are up about 40 or 50% from their lows in early November last year. So over sort of 3 months or so. Energy is up even more than that. The oil price is up a lot, and energy stocks are up dramatically despite ESG and all that sort of that sort of style of investing, which would suggest people wouldn't buy energy stocks. They're up dramatically, and other cyclicals and materials and commodities. So the market's been dominated by growth. It got to the stage whereby of the US stock market capitalization, 50% of it was growth or tech stocks. So if you added up IT and Amazon, which dominated consumer discretionary, and then of course you have communication services dominated by Facebook and Twitter, and all sorts of techie type stocks, the main IT stocks as well. That was 50% of the market cap of the US, and the US was over half the market cap of the global market. So that had been dominant up until really late September, early November. And as I say, we've since then seen very dramatic rotation into the cyclical and value areas of the market. And of course, the US 10-year bond yield is absolutely central to this. Really, we've had low bond yields for a long time post GFC, telling us that the global economy is struggling to generate growth. And of course, what's happened is people have paid up for secular growth stocks, which is what growth stocks are. Of course, they pay over and above the odds for companies that they think can deliver long-term secular ongoing economic earnings growth. And in a time of low economic growth, they pay more for that. So if I'm right, and the world is morphing into a world whereby growth is easier to come by, more of it, more broad-based, and a little bit more inflation, then people stop paying up so much for secular growth relative to cyclical growth. And that's when the value and the cyclicals start to outperform on a sustained basis. So, and of course, bond yields sit at the heart of that. Bond yields have been depressed for several years because of that inability to generate growth. They've sort of done that as the banking system's been healing and shrinking post GFC, and that's kind of done now. I think that phase is over, and we'll still see bond yields trending up. And I mean, the easiest way to see it is to just look at the relationship between bond yields and the banking stocks. So when bond yields back up, banks tend to outperform, as we've seen in the last few months. So bond yields are absolutely central to this relative trade of growth versus value. Yeah, I mean, in the short term, we've had a good bout of consolidation since late January. I think markets have had their third phase of consolidation since their bear market lows in March last year during the pandemic. That phase of consolidation since late January is largely played out. And I think we're going to see a new leg higher over the next month or two. That would be our short-term view. And actually, I think bonds are pretty oversold, so bond yields might stabilize, and that may well allow growth to actually have a bit of a bid underneath it and have a good month or two in the short term, because bond yields backing up has really caused a lot of damage in that area. So if that stops, I think they release very oversold tech sector to bounce and rally for a month or two. Maybe not much beyond that, but certainly for that short-term time frame. In the longer term, there's still plenty of monetary and fiscal support for this market. Liquidity remains very loose, and I think markets are going to trend higher as we sort of play out and continue to play out this phase one of a stylized cyclical bull market. Well, it's a big question whether or not it's game over for tech. I mean, there's clearly been a lot of money going into the area in the last 4 or 5 years. It's been one of the most crowded trades for a long period of time. There's been a lot of froth building up, a lot of speculative excess in recent last 6, 9, 12 months, whether you look at the electric vehicle space, Tesla doubling its market cap in a matter of months last summer, or or the speculative frenzy. So yeah, I mean, there's a lot of weight of money's gone in there, so there's a real risk that needs to come out. Whether or not that bubble has burst finally is very, very hard to judge. It's clearly damaged, and it's clearly struggling. But as I say, I think it might bounce for a month or two, and I think we'll see the strength of that bounce. That'll tell us more about the long-term sustainability of the sector. But for choice, I think tech's leadership has gone. Whether or not the bubble has burst is hard to say. And of course, this feeds straight into US versus Europe because, as I mentioned earlier, US is 50% of its market cap is growth or tech. In Europe, it's the percentage of market cap that's growth or tech is trivial. I mean, the UK, for instance, I know the number is 1.5% of the market cap of the big cap FTSE 100 index is growth or tech. So it's trivial in these markets. European market is much more value cyclically oriented. Think of the German market; it's got a lot of cyclicals in there. You can make the same sort of comment in terms of banks across a number of European markets. So they're very much about the value in the cyclical trade, and bond yields backing up is good for them. The US market is very heavily dominated by growth, so it should struggle. So the relative pair is about your view really largely on value versus growth. And as I said, we favor value over the medium term. So we favor Europe over the US.